Welcome to this explainer. Okay, today we're doing something I find incredibly fun and honestly highly practical. We are going to put on our detective hats and crunch the real numbers from a classic scenario known as Problem 11.13, focusing on a business called the Whipper Company. We're going to completely move past abstract theories and get our hands dirty with the actual step-by-step math that investors use every single day to decide if a company is worth their hard-earned money.
To keep things manageable, we've broken our investigation down into 6 logical, bite-sized sections: the investment case file, profitability, liquidity and efficiency, market value, solvency, and finally, the final verdict. Let's jump right in.
Section 1. The investment case file, a financial detective story. Okay, let's dive into this. Every good financial investigation really has to start with a profile of who is actually making the investment. Why? Because your risk tolerance changes everything. So here is the central question we need to answer today. Should you invest your funds in Whipper Company's common stock? For the sake of our case file, let's assume you're a young single professional with some extra cash to invest. Since you're young and have a long time horizon, you actually have a decent tolerance for risk. You're not just looking to park this in a safe savings account. You want your money to really grow. Is Whipper Company a smart bet for someone with this profile?
To uncover the truth and answer that question, looking at just one single year of data is never enough. A company might just have one lucky year, or maybe one abnormally bad year. That's why we have to compare the precise data points from 2019 directly to 2020. Trend analysis is absolutely our best tool here. We want to see exactly which direction this company is moving over time.
Moving to Section 2, profitability, measuring ROI and ROE.
At the end of the day, we really just need to find out how much money the Whipper Company is actually making relative to what they have to work with. We'll start with a massive foundational metric, return on investment, or ROI. Conceptually, ROI just describes the rate of return that management was able to earn on all the assets they had available to use during the year. Like, if a company buys buildings, equipment, and inventory, how efficiently are they turning all those assets into pure profit?
Let's look at the mathematical storytelling behind this using a DuPont breakdown for the year 2020. This neatly breaks ROI down into 2 parts, margin and turnover. First, the margin. Whipper had a net income of $300 million generated from sales of $3,300 million. Then, turnover. They generated that $3,300 million in sales using average assets of $3,175 million. The cool thing here is when you multiply the profit margin by the asset turnover, those sales figures just cancel each other out. That leaves you with net income divided by average assets.
And when you do that final division, so $300 million in net income divided by $3,175 million in average assets, you land on a 2020 ROI of 9.4%. Now here is why that trend analysis we talked about is so vital. Back in 2019, their ROI was only 8.5%. So the crucial takeaway here is that management is getting noticeably better at squeezing profit out of their assets. They are definitely trending up. But what about the return specifically for you, the shareholder? For that, we use return on equity, or ROE. Here's the exact step-by-step math. Step 1, we grab that same 2020 net income of $300 million. Step 2, we look at the average stockholder's equity, which is the actual money belonging to the owners, coming in at $1,275 million. Step 3, just divide the two. That gives us a really solid ROE of 23.5%. For context, anything historically between 12 and 18% is pretty average for American manufacturing. So 23.5%, that means they are generating excellent returns on shareholder money. Oh, and by the way, this is up from 21.9% in 2019. Seriously, it's just another fantastic upward trend.
All right, Section 3, liquidity and efficiency metrics. Checking cash flow.
Now, profit is great, but listen, if a company doesn't have enough cash on hand to pay its short-term bills, it can go bankrupt anyway. We need to make sure Whipper Company isn't just profitable on paper, but solvent in reality. Now, what's really interesting about this slide is how visibly the numbers improved from 2019 to 2020 to ensure that short-term solvency. Working capital, which is literally just current assets minus current liabilities, grew from a $100 million cushion up to a $150 million cushion. Even better, look at the current ratio, which just divides current assets by current liabilities. It jumped from 1.13 up to 1.3. This means for every single dollar of short-term debt they owe, they have $1.30 in highly liquid assets ready to cover it. They are breathing much, much easier in 2020.
But efficiency matters too. Let's look at their average days sales in accounts receivable. For Whipper in 2020, this sits at exactly 34 days. What this means in plain English is that from the moment they make a credit sale, it takes them, on average, just over a month, 34 days, to actually collect the hard cash from their customers. That is a very fast, healthy turnaround. It absolutely proves their collections department is operating incredibly efficiently.
Moving right along to Section 4, Market Value and Dividends.
Okay, so we've established the company is running really well internally. But how is the stock market pricing this business? Before we can even look at the stock price, we need the earnings per share, or EPS. Step 1, take our trusty net income of $300 million. Step 2, identify the number of outstanding shares, which the case file lists as 44 million for 2020. Step 3, simply divide the net income by those shares. That yields exactly $6.82 per share. Think of it this way. Every single share of this company represents about $6.82 of pure, unfiltered earnings.
Now, let's turn this calculation into a bit of a puzzle for you. If you know the EPS is $6.82, and the financial data tells us the price-to-earnings, or PE ratio, is exactly 14 at the end of 2020, how do you find the actual market price of the stock? I mean, think about what PE actually stands for. Price divided by earnings equals 14.
Yep. To solve the puzzle, you just multiply the earnings per share by that multiple of 14. So $6.82 times 14 gives us a market price of $95.48 per share. That is exactly what it costs to buy a single slice of the Whipper Company out on the open market.
But wait, do you get paid just for holding the stock? Actually, yes, through dividends. In 2020, Whipper Company's dividend yield was 1.19%. And their dividend payout ratio was 16.7%. So, what does this all mean for you as an investor? Well, the payout ratio tells us that out of all their net income, they only hand out about 16.7% as cash to shareholders. They keep the vast majority, over 80%, to reinvest and grow the business. And that 1.19% yield, it just means if you buy a share for $95.48, you're getting a small cash return of just over 1% annually. For our young investor profile, this is honestly perfect. You don't need a massive cash income right now. You want the company aggressively reinvesting its profits to drive that stock price way up over the long term.
Almost there. Section 5, Solvency and Debt Risk. We've looked at short-term liquidity, but we've got to check our final analytical pillar to make absolutely sure the company isn't secretly drowning in long-term debt that could wipe out all these great returns. And this brilliantly illustrates the long-term safety of the company. Look at the 2020 debt ratio. Right now, the company's assets are financed by 58% liabilities, meaning debt, and 42% equity. Now, I know 58% might sound a little high at first glance, but again, you have to look at the trend. Back in 2019, their debt ratio was 61%, so they're actively paying down their debt and shrinking that ratio to a much healthier, safer level.
Just to further confirm they are safe from your debt, we'll spotlight the times interest earned metric. This takes their earnings before interest and taxes and divides it by their interest expense. For 2020, the result is 2.75. In plain English, this means their earnings are nearly 3 times higher than the interest payments they actually owe the bank. They can comfortably, and I mean very comfortably, cover their interest expenses with a massive margin of safety.
Let's move to our final section, Section 6, the final verdict. Let's see how this all builds to our big conclusion. We've crunched the numbers, we've analyzed the trends, now it's time to render the final verdict on problem 11.13 and the Whipper Company. And guys, the evidence points to an incredibly strong case. Across the board, we are seeing fantastic upward trends. They have an increased return on investment and return on equity, proving management is getting way more profitable. They have improved working capital and a higher current ratio, proving their short-term cash flow is locked in. Plus, they have a higher earnings per share and a lower, shrinking debt ratio, protecting them from long-term risk. Literally, almost every single vital metric improved for the Whipper Company in 2020.
So I'm going to leave you with this final provocative thought. Based on the hard evidence we just dug up, and keeping in mind our profile of a young professional looking for real growth, would you add this stock to your portfolio? The math strongly suggests it would be a fantastic addition. I really hope this explainer empowered you to see how breaking down the actual financial data can completely take the mystery out of investing. Take this framework, apply this financial detective work to your own investing journey, and keep crunching those numbers. Thanks for hanging out and learning with me today.